Hello, this is Shen. Welcome to my channel. Let's start. So in this video, we're gonna talking about the overview of conceptual framework, the key tips on the IS1, and the new IFRS 18. So this chapter is not hard, but it integrates to other topics. So if something isn't clear right now, no worries. You can always come back to check. So let's start with the big picture. We're gonna talking about those topics now. Objectives of financial reporting, underlying assumption, accounting basis, qualitative characteristic, elements of financial statements, and the measurement basis. Now, what is the objective of the general purpose of financial reporting? There are two main goals. First one is to provide financial information that is useful to existing and potential investor, lender, and other creditors in making the decision. Why? They need those information to decide if invest or not. Second, how efficiently and how effectively the entity's management and the board have discharged their responsibility. What this means? For example, at the beginning of the financial year, the CEO wished to increase the net profit by like 10%. So by the end of the year, we need to see if these targets met. Now, what information do we need? We need the statement of financial position, the statement of profit or loss and other comprehensive income, the statement of changing in equity, the statement of cash flow, and the notes. And in order to make those information clear, we need to understand the following content. So first, what is the reporting period? Reporting period is the specified period of time that we report the financial information. Why we need to set the time? Because we need a comparative information to measure the performance of the entity. Now, what is the going concern assumption? So we assume that entity will continue operate for the future. Entity has no intention to liquidate. Why this important? Because the value of assets or liability is based on the normal operation. So if entity intend to liquidate, we need to adjust the value. Thinking about that, I have a car wash business. The high pressure washer is essential equipment for the business, but because it is the cash generating unit. But if I decide to close my business, the washer for the buyer is just a machine and it cannot generate any revenue. So the value is changed. So in order to make those values stable, we assume the business will operate under the normal condition. So if not going concern, a different basis and disclosure requirements will apply. Now, what is the reporting entity? Just remember that in general, the legal entity must be reporting entity, but the reporting entity is not necessarily a legal entity. For example, I register a company, so the company itself is a legal entity. And for a company, I need an accounting service, so also my reporting entity. But if I just want to hire one accountant to report one machine, this machine is my reporting entity, but the machine itself cannot represent as a legal entity. And now what is the consolidated and non-consolidated financial statement? The consolidated statement including all financial information of your parents and your subsidiary. And non-consolidated statement is only the information, only the parents' information. Now, what is the accrual basis and the cash basis? Accrual basis is is only measured when the rights and obligation happens, and it applies to most of the entity. The benefit for this one is it truly reflects the operating and the financial results. And for cash basis, it's only measured when the receipt and payment of cash happens, and it applies to the small business and non-profit organization. The problem for the cash basis is the financial results may not truly reflect. You can pause to check, and now I will give you an example to explain the difference between these two. So, for example, I open a bubble tea shop and I hire two staff to manage the shop. But I'm not sure who is better, so I need a firm's result to decide. So if the rent is paid every 2 months, for the first month, the staff A earning 100K, the cost is 60K, so he makes a profit of 40K. For the second month, the staff B earning 105K, the cost is 60K. The rent is charged 15K, so he only makes the profit of 30K. So let's just compare the red parts and say that staff A is better than staff B just based on the profits. The answer is no, because it's unfair. The staff B gonna complain that yes, rent is charged in the second month, but for the first month, the staff A also using the shop, so the rent need to spare into 2 months. So I adjust the profit. Now for staff A, adjusted profit is 32.5K, and for staff B is 37.5K. So based on this example, if I just look the profit, I'm using the cash basis, and we will see it's not reflects the real results. And if I agree staff B's suggestion, I'm using the accurate basis. The result is more accurate. And in most of the time, because we're dealing with the entity, so we need to use the accurate basis. Now we need to study the qualitative characteristic of useful financial information. So let's see the table. We have two fundamental and four enhancing characteristics. What is the relevance? If the information can change users' decision making, or if the information is material. What is material? This word is quite big. My understanding is thinking who is your primary user. Would this information change their mind? So if your answer is yes, it is material. What is faithful representation? The information must be complete, natural, and free from error. It's very strict. What is the comparability? The entity can compare itself across different periods, and it can also compare the company during the same period. What this means? Thinking that you've just finished your final results, final exam, and you get your final results. So you can compare your marks with your friends to see which part you are good at it. Or you can compare it with your last month's paper to see which part you are improved or not. And what is the verifiability? Information represents the economic phenomena it purpose to present. What does this mean? Confused, right? So let me make this simple. If the accounting information states that event A happened, then this information must be true and actual exist. So this information can be supported by like contract or like the documents. What is the timeless? Information is available in time. It's quite strict. And what is the understandability? Anyone can read the statement. Now we move to the elements of financial statements. Before I start to explain it, one important tips I have to give to you guys that all the series question you cannot just copy and paste from the handbook. You won't get any marks. You need to explain it by your own words and applicate it relating to your scenario. So what would you need to explain? The key parts in the definition. So let's start it. What is assets? Are present economic resource controlled by the entity as a result of past events. The economic resource is your cash inflow, your favorable exchange, or your something you can measure by the currency. What is the control and the right mean? So mean you hold the ownership or nominal belongs to you. So you have the right to receive the economic resource. And what is the past event? The things happened in the past. So now let's do some trick quiz. First one, a company has decided to purchase 4 rockets in 2 years. Is this the asset? Answer is no, because it's not from the past event. They just make the decision. Second one, a company has 25 years old truck, which is write off already. Is this truck an asset? The answer is no, because this truck cannot produce any economic benefits anymore. The last one, a company purchased thousands of pens as a gift for Black Friday marketing purpose. Is this an asset? The answer is no, because for marketing purpose, it's more like the advertisements, and the economic benefit is finished when the pen gives to the customer. So it's more like the sales expense. Now, what is liability? Liability is a present obligation of the entity to transfer an economic resource as a result of past events. What is the obligation? The obligation is your duty or responsibility that entity cannot avoid. What transfer mean? The transfer is your cash outflow. Like you have to pay something, or you need to deliver the goods or the service, or is something unfavorable exchange. And what is the past event? Things happen in the past. The trick point here is it must be present obligation. So, for example, if the scenario said that company has been sued, but the case has not yet been started, this is not a liability because there's no present obligation. The detail will be teach in IAS 37, the provision, but not now. So let's move to the equity. Equity is the residual interest in the assets of the enterprise after deducting all the liability. This means accounting equation assets minus liability equal equity. Not too complicated, but just remember that your other comprehensive income is going to the equity. And I'm not going to explain the income and expense. Just check the equation for yourself. Now, when you answer those definition question, first, you need to explain all the key points in the definition. And the second, you need to match the recognition criteria. What is this? So you must to prove that information is relevant and faithful represents. To prove relevant, so you need to judge the assets or liability is not existence uncertain, not low probability of inflow or outflow of economic benefits. So your task is to establish based on the facts that the item's existence is certain and the relate economic impact is reasonable assured. And to prove the faithful represents, you need to judge that measurement is not uncertainty. So you must have an amount in your scenario. So now, when you de-recognize the assets or liability, when you lost control or no longer have the present obligation. Now we need to understand the measurement basis. The historical cost. What is this? The definition in the handbook is quite complicated, but just make it simple. Treat it as our original cost. And what is the current value? The current value is the value after the deduction, after the adjustments. So the example like your fair value, the value in use, and your net realizable value. We will learn those values very soon, and keep in mind the historical cost and your current value must including the transaction cost. So these are basically the majority content in the conceptual framework. Very, very important notes. We need to note that the conceptual framework is not a standard, which means it will never override others' standards. So it's more like the guidance to help the board to develop the new standards. So you only use it when there's no other standards to refer to or as required by the question. So you can find more detail in your handbook and please highlight it. There are a lot of exception and explanation in it. And always remember, your handbook is your cheat book in the exam. Now let's move to part 2, the key tips on the IAS 1. So IAS 1 is called the presentation of financial statements. So many students found this challenging because of the memorization involved. But here's the secret. The format marks are easy mark. So even if your number is wrong, but if you placing the number into the right section, you still can get those marks. So back to the study. Which statements you need to know? Those 5 things. My personal tips in your exam is your handbook part B as format example. Using that in your exam. These are the general factors for IAS 1. The statement must be fair presentation. So if IFRS is applied, follow the rule. The statement must be going concern. And if you have any material information, those material information must be presented separately. And you are not allowed offsetting the value, except if required by the standards. The frequency of reporting at least annually. And you need to provide the numerical and descriptive information in general to continuous information. And you must keep the consistency. Your accounting policy and measurement basis must be keep the same over time. Why? Because we want the user easily understanding the statement. And for each statement, please make sure the following concepts include your name of the entity. You specify whether it's individual or group statements, the dates, the presentation currency is rand, dollar, yuan, or yen, the level of rounding must be indicated. Nowadays, the new IFRS 18 is coming. What is this? Let me quick summarize this. So IFRS 18 is called Presentation and Disclosure in the Financial Statements. The name is similar like the IS1. So let's quick check the timeline. In April 2024, the International Accounting Standards Board, IASB, issued IFRS 18 approved by 14 members. This IFRS 18 is effective for annual financial reports beginning on or after 1st January 2027, with early application is acceptable. So for the 2026 CTA student, congratulations, you may and high probability going to test this new IFRS. But do not stress, it's not that hard. As I said, it's similar like the IS1, just add some new points. The requirements that set out the requirement for presentation and disclosure of information in the financial statements to help they provide the relevant information that Facebook represents. The requirement is only mentioned that presentation and disclosure requirements. So the recognition and the measurement is keep the same. So what is the key change? The key change is where the new action is coming. First one, your statement of profit, loss, and other comprehensive income is changed. So you need to study the new structure. Second, more information need to disclosure. And the last one, you need to understand the note of MPM, the management defined performance measures. What is the relationship with the current IFRS and IAS? So IFRS 18 gonna replace the IAS1, and some section of IAS1 move to the IAS 8. And now IAS 8 renamed to the basis of presentation of financial statements and including the content of IAS1. So IAS1 is no more exist. Now, let me discuss what is the new thing and how it gonna influence your exam. First thing first, when there are new accounting policies coming, first thing coming into your mind is integrate with the IS8. Second, what is main business activities? IFRS 18 emphasizes on its concepts. What is this? The business activities is based on the scenario that question gives to you. But usually we assume it is the manufacturing company. So IFRS 18 classify two and only two activities. The first one is normal activities. It's for the manufacturing company, and we call this entity with main business activities. And the second one is special activities. So this one is for company that invest its money in particular assets, like to issue the debt or issue the equity instruments, or they put the money into the investment property. Second is like the bank, like the insurance bank, insurance company, or those companies provide the financial service. And we call those entity with specified main business activities. So IFRS 18 requires classification of all income and expense into 5 new categories. They are operating, investing, financing, income tax, and its discontinued operation. They are look familiar because it's like the cash flow statements, but not the same. So in your operating category, you need to including all the income expense plus any income and expense that not classified in other category. And for investing activities, so you must be generate the return. And for your financing activities, you must be obtain the loan, the fund, or reinvesting. And besides that, the new subtotal must be disclosure in the IFRS 18. Your operating profit, profit before financing and income tax, profit for the year. And I will give you example, and you will see where you put those subtotal. And this example is based on the South Africa CICA syllabus. What I mean, the name of the entity. So let me add it. ABC Pty Ltd. Statement of profit or loss and other comprehensive income for the year end, blah blah. So what including in the operating activities? Your revenue, cost of sale, your IS 16, your inspection fee, your maintenance fee, your depreciation, IS 38, your amortization, your the expense during the research phase, your impairment loss, your lease payment, your legal or consulting fee, your share-based payments, and the gain or loss on financial instruments through profit and loss. And last one, your foreign exchange difference. What's included in the investing activities? Your rental income or your finance income, your gain or loss on revaluation, especially for the investment property, your interest from the debt instruments, your foreign exchange difference, and the share of profit of associate, and gain on disposal of associate. And what's in your financing activities? Your interest on the lease liability and foreign exchange transaction. And you see why I put foreign exchange difference into 3 categories. Because now you cannot just aggregate all your IAS 21 together. You must separate it based on its nature. What does this mean? So for example, if this foreign exchange difference is due to the receivable account, it's your operating activities. But if the foreign exchange difference is from your loan, it's a financing activities. Now we're gonna see the change to the statement of cash flow. So before the IFRS 18 introduced, if you're using the indirect methods, you start from the profit before tax. But now you need to start from operating profits. And before, when company pay the dividends or interest, the company has the option to choose disclose it in operating or financing activities. For now, no more option. You must include in the dividends and the interest in your financing activities. And the last one is change the name of cash generated from operation to cash from operating activities before income tax. For cash flow statements, you need to adjust those non-cash items, right? The following item should not require to adjust anymore. Why? Because now they are classified as investing activities. First thing, your depreciation on investment property. Second, your gain or loss on financial assets. Third, the share of profit from associates. Now, let's see. What is the MPM? The Management Defined Performance Measures. What is this? So in the past time, if you read the statement or integrate annual reports, you can find those like the CEO, CFO comments to the public, like the news, the social media. Those article is from management perspective. But now, IFRS 18 requires us to aggregate those information and disclosure in a single note. So the definition said that MPM as subtotal of income and expense. What this means? It means some income and expense need to adjust, which influence your final profit. So what you need to disclosure? And description of financial performance, an explanation of how the MPM is calculated, and its explanation of why MPM provides the useful information, and reconciliation to the most directly comparable subtotal list in the IFRS 18. And if a company changed the calculation of MPM and introduced a new one, you need to give the explanation and the reason, and you need to give the restate comparative information to show the difference. So what you can adjust. So it must be from the income and expense, or those things is underlying the performance. The income and expense must be one's own, non-operating and non-core business activities. The example like your impairment loss. If you think your impairment loss is not reasonable, you can add it back. Or like your litigation fee, because the litigation fee is once-off fee, so you can add it back. Thank you for your watching. See you next time.